Hello, and welcome to The Advantage Investor, a Raymond James Limited podcast that provides perspective for Canadian investors who want to remain knowledgeable, informed, and focused on long-term success. We are recording this on August 15th, 2024. I'm Chris Cooksey from the Raymond James Corporate Communications and Marketing Department, and today, head fixed income trader Harvey Libby returns to the podcast for his regular update visit. Welcome back to The Advantage Investor, Harvey. I really appreciate you taking the time to talk today, and as always, I hope you're doing well.
Thanks, Chris. Yes, I am doing really well.
Good to hear. The last time you were on the podcast was in April, and we've had a couple of rate cuts in Canada since then, and certainly appears to be on the table in the U.S. as well. So why don't we begin with a recap of where we've been so far in 2024?
Well, sure. Since the last time we talked, yields have gone down dramatically, probably about 50 basis points. I think in late April, we were around 375 on a 5-year Canada. We're now at about 3%. Same thing about in 10-year Canadas, we're around 375 as well, late April. And now we are at about, I think this morning we were at 308. A lot of, optimism in the market, a lot of bullish views, a lot of ups and downs. It's been quite crazy, actually. The volatility in the market, you don't often see this much volatility in fixed income markets, and there's been a lot. You'll have numbers out, whether CPI or PPI, jobless claims, that kind of thing, are moving markets by 5 or 10 basis points in one day, which is big volatility for fixed income markets that are usually, pretty stable, as it, compared to compared to equity markets or anything else in the world. Just talking about what economists are still expecting rates to go down further. There is a big optimistic push. We had that late last month that at one point we thought there was going to be 9 rate cuts by the end of 2025 in the US. Right now we're back to that. We kind of went from 9 to 8 to 9, and it's kind of fluttering in there for economist views. I personally think that's a little bit too optimistic. How fast can the Fed actually cut? There's just so many times they can actually cut, and you'd think they would pause, in my mind, especially in Canada anyways. Like in Canada, they're calling for like 75 basis points by the end of the year, and economists are worth of cuts, and I'm thinking maybe 50 basis points. They're also calling for by July next year that we'll have about 6 cuts to our overnight rate, which is currently at 4.53. They think it's going to go at about 3%. So that's great. That is really good. That is really good for the average consumer out there who wants to go and, their mortgage is coming due, so they have to redo that. It's great news for them. It's not great news for investors that are trying to invest for the long term. That's our problem right now. Yields are starting to evaporate. And What we've been telling them, and you've helped with that, is, invest, get in while the going's good, and keep investing, right? So we're doing the same kind of thing now. We're doing the exact same thing as telling people to try to extend gradually into this because rates are, they're definitely going lower. There might be a bumpy ride, and you might have 10 beeps swings, but the trend is your friend, and it's going down. So yields are going down, that's for sure.
Okay. Now, inflation, obviously we've seen prints where it definitely seems to have come down a bit. Doesn't negate the fact it seems to cost $25 for a bag of chips, though, still. So what's inflation informing on the markets right now?
Inflation is exactly creating optimism for rates and rates to go downward. So it's definitely fueling the fire. Canada last CPI print was at 2.7%. Like go back to like middle of June 2022, and we were closer to 8%.
Okay.
Okay, like it has come down dramatically. In the US, last print was 2.9%, so pretty close. Canada, US, pretty close on their CPI numbers. And in June 22, which seems to be the high, they were over 9%. Like dramatically has come down, and it seems to be going in that trajectory, which is definitely helping economists predict that rates will go lower.
Right. And that
Yeah.
gets back to what you were saying, I guess, around yields and that sort of thing. Last
Yeah.
time you were on, we were saying it's probably going down. This might be the
Yeah.
best time to start locking in. But any further comment around rates, or is it just really
Think,
like we like to talk about the ladder on when we talk on this show?
yeah.
Is that where we're at still?
Well, it's still, you know what? It's still very safe. Okay. It makes sense. It makes sense for the normal investor. Yeah, it's the safest way to go, but maybe you want to go instead of a 1 to 5 year ladder, maybe you want to push out a little bit to try to get to 10 years. Most people are more comfortable with a 1 to 5 year ladder. They go to their bank, they see a 1 to 5 year GIC they get offered, so they can compare it to something. So
Mm.
the easiest sale right now for our financial advisors, or for the last year, has been a GIC is yielding X. Well, a corporate bond is yielding a little bit less, but it's at a discount. So
Right.
the after tax implications are way better in a taxable account. So after tax income is the way to go. And it's a really was an easy sell to show that pickup by buying an after tax or discounted bond compared to a GIC. In 1 to 5 years, you compare it against a GIC. It's easy to show. Clients are comfortable with 1 to 5 years. Nobody wants to go like 30 years. Who knows what's going to happen in 30 years, right? But 1 to 5 years, it's very safe.
Mm.
Um, and with a 1 to 5 year ladder that we keep talking about, the reason is because you do one product each year for 5 years, and every year, 1/5 of that comes due or matures. You reinvest in the next rung. And in a normal rate environment, the next rung or the next year should be a higher yield than the fifth year out, or sorry, the fourth year out, because you're going to be investing in the fifth year. So it's just a constant rebalancing, a constant reinvesting at the new rates, which makes total sense for investors.
And of course, like sometimes when it comes to fixed income, the returns are the returns. However, we shouldn't be minimizing the safety aspect of this. It's a
Oh,
section of your portfolio that provides maybe the floor, we could call it.
you know what? That is a very good point, actually. The safety aspect of it is very important. We tend to, when rates go to 1, 2%, we tend to forget about fixed income and push it to the side and say, well, but we've got this dividend stock that's yielding 3%. That makes way more sense, but you're taking away the safety aspect of it. This is a sleeve of your portfolio, whether it's, 15%, 20%, 30%, 50% of your portfolio, you should still be diversified. You still should be in this sleeve.
Mm.
And that going forward, has been the biggest thing. Sorry, going backwards, that has been the biggest thing to try to make sure people were investing still in fixed income when rates were 1 and 2%, because they still should be in something. Like when rates were at 1 and 2%, people should have been probably going shorter term, but they still should be in the instrument.
Right.
And it's for the safety, that's for sure.
All right. Well, let's move to opportunities. I think last time you were here, we talked about opportunities within corporates. Is that still the case? Is there still opportunity there, or has
Yeah.
the market evolved?
No, corporates are still, in my mind, the sweet spot in the market. Something you definitely want to be investing in. and just because of the pickup. And we've got in Canada, especially, we've got such high quality corporates. Most corporates in Canada, I want to say it's over 60% of the corporate bonds in Canada are bonds. So we have good quality corporate issues outstanding. So 1 to 5 years, 1 to 10 years, there's a lot of issues around. 1 to 10 years, not so much, because banks don't seem to want to issue that long. They'll be more to the 5 year area, but in that, like, from 5 to 10 years, you do have other like higher quality names that you can go into: Bell Canada's, Enbridge, CNR. There's a lot of good names. So you look at those, you compare those to provincials, you compare those to Canada's. Like, if you're risk adverse, I would never buy a Canada. I would always buy a provincial. If you're looking at a tier wise, it goes Canada's, provincials, corporates, investment grade corporates, and then high yield corporates. Now, high yield corporates, I really, it's not that I don't like them. They're such an intricate part of the market. I think you're better to buy an ETF or something that someone is actually looking at these corporate bonds and make judgment on them, actually look at the balance sheet. People way smarter than I'm ever going to be, and buy them, because it takes a lot of a know-how to actually manage high yield. So we stay away from high yield. We'll do the investment grade stuff, and we'll show you a product like that. But I think it goes back to whether a corporate makes sense versus a GIC right now. And I don't know if you know this, Cooksey, but it flips back and forth.
Right.
So GICs are slow to react to the market. You have a Canada bond that reacts to the market in 30 seconds. And if there's numbers out in the market, it reacts. In 3 days. It can, give up 30 basis points in yield. It can, add 30 basis points in yield. Well, GICs and GIC issuers don't react that fast. They will wait a week. They will wait 2 weeks before they start moving their rates. And so there's opportunities if you're looking to invest at that time to buy a GIC. So if you're a buy and hold client, you don't care. You're going to buy and hold it anyways. If you bought a provincial, a Canada, or a corporate, if a GIC yields better and you don't need the after-tax benefits of it, or if just yields better, even after tax, it yields better, then you should be buying a GIC. So you should be going to your financial advisor, and that's what you're paying them for, is to give you advice on this so that they can tell you what is the best product for the term you're looking in.
Right. And I guess too, like as you mentioned with high yield, and through a mutual fund or ETF or whatever is the right choice for you. These managers are also in contact with the companies, so they'll have a deeper view into the market in that regard too, right?
100%. They're talking to the companies. They've gone through their balance sheets. They've looked at it. They know that, if something did happen to, the company itself, that there's probably, it's probably worth X on a takeout basis. Sure. Like they're smarter than we are, Cooksey.
Yeah. Well, that's most people for me, but anyway, I said it. You didn't have to. Anyway, Harvey, thank you for taking the time today. We'll talk again in the fall for another update. Enjoy the rest of your summer.
Yep. Thanks. You too. Take care.
Reach out to us at advantageinvestorpod@raymondjames.ca. Subscribe to The Advantage Investor on Apple, Spotify, or wherever you get your podcasts. Please contact your advisor with any questions you have. On behalf of Raymond James and The Advantage Investor, thank you for taking the time to listen today. Until next time, stay well. This podcast is for informational purposes only. Statistics and factual data and other information are from sources Raymond James Limited believes to be reliable, but their accuracy cannot be guaranteed. Information is furnished on the basis and understanding that Raymond James Limited is to be under no liability whatsoever in respect thereof. It is provided as a general source of information and should not be construed as an offer or solicitation for the sale or purchase of any product and should not be considered tax advice. Raymond James advisors are not tax advisors, and we recommend that clients seek independent advice from a professional advisor on tax-related matters. Securities-related products and services are offered through Raymond James Limited, member of the Canadian Investor Protection Fund. Insurance products and services are offered through Raymond James Financial Planning Limited, which is not a member of Canadian Investor Protection Fund.